Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, October 19th, 5:03 p.m. Eastern Time, coming to you from the financial capital of the world, St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, continue to be in a correction. Market trying, but battling as the bulls and bears are in an epic battle to take control of the market, going back and forth over the last 5 days. You can see over here in the trend gauge, we do have some leadership. It's more leadership of stocks that are holding up and kind of trying to get near the tops of bases. Should we get a follow through day and some strength, they'll be the ones that we focus on. I actually could very easily make a 2 or 3 versions of 21 over 21. There are strong stocks, but again, nothing making substantial progress. So we've got neutral with a green arrow there. Short-term 21-day exponential moving averages, a little bit of a pullback, a give back today. S&P closed slightly above the 21 yesterday, gave it up today, but did bounce off the ADMA, so a mixture there. We're looking for some follow through. We still might get it, but we didn't get it today. 50-day moving average and 200-day moving average, those are our medium and long-term trend indicators. All 5 of the major moving averages are below those levels, so they are flashing red / bearish / downtrend. So what happened today? Overnight, the futures very strong. Woke up this morning to the futures being flat. Another couple hours later, the futures were red. So a big negative overnight reversal. Opened down 0.6%, tried to rally, actually got to positive, but then the index is faded. Trend down day till the last couple of hours. We recovered some of the losses. The battle at the 21-day exponential moving average continues, is the bottom line for the S&P 500. The NASDAQ 100 tried to get into the 21 early, but failed there also. So the numbers end up being red on the day. Value outperforming growth again. G6, this is our 6 ETF composite, down 1.7%. S&P down 0.7%. NASDAQ 100 down 0.4%. Dow Jones Industrial Average down 0.3%. Mid-caps down 1.8%. Russell 2000 down 1.7%. Global Diversified 60/40 stock and bond down 0.87%. In-house GROTECTION down 0.21%. We'll go through the tail of the tape and some charts of interest. But first, let me go through a brief explanation of why we do what we do here at Revere, and it can pretty much all be summed up in this one chart here. If you've saved your whole lifetime, headed toward retirement, and you get a negative sequence of returns similar to these highlighted areas, it can really throw your plans for a loop. So I watched it happen in my family. I know several other people where it happened to. Also, I know some senior citizens that I talked to at the grocery store that were bagging groceries after the great financial crisis because they didn't have an advisor that protected their downside. We strive to not let that happen at Revere. We protect the downside first, and then the upside takes care of itself because you are compounding from a much higher asset base when you don't go through severe bear markets like this. Average of those 6 severe bear markets going back to 1968, average loss 44.5%, back to even, takes 80% to get there. Look, I know that stocks trend higher in the long term. I also know that there are severe short-term and medium-term pain thresholds that you can't just ignore. And that's what we're here to do. You'll lose sleep if you have no plan. You'll lose sleep. You'll lose mental capital, financial capital, emotional capital. Our in and out strategy addresses all these issues, and to us, it's a common sense strategy. And let me quickly go through it here. This is a chart of the S&P 500. You've got the 3 lines. These are our 3 trend indicators. Green line, short-term 21-day exponential moving average. Red line, medium-term 50-day moving average. Black line, 200-day moving average. When we're trending above these, everything is all fine and dandy in the market. We're as long as we can possibly comfortably be. We go sideways. Some of our stops will lighten our exposure in the market. If we really start to roll over and go lower, the slopes of the lines of the short term and intermediate term will roll over. That's a signal to us to get even more defensive. And if you break below the black line, the 200-day moving average, this is when we get an extreme defensive posture. And it's not fear mongering, it's fact based. All of these bear markets take place below that black line, below the 200-day moving average. We broke below it during COVID. We got out of the way. We broke below it in early January. We got out of the way. We tried to get back above it, but we broke back below it and failed to get above it on April 21st of this year, and the slope of the line rolled over, and things have been very dicey since then. We had one rally. What did it do? Go up right into the declining moving average and failed again. We made some money during this rally, gave some of it back during these downtrends. Now the latest thing we've had is a big undercut and reversal off of the CPI data. This is the market saying that's it, we're all sold out, we're not going down anymore. When the markets react positively to negative data, it's a good sign. Not saying that this is over. It absolutely isn't. We're battling at these key levels, but we've got plans to get in and to get out. We got back in here. We got stopped out. We took another shot when we got back above the 21. We're sitting on some very tiny losses. We've got paper cuts. These paper cuts all take care of themselves when the trend changes, and the trend will change. It'll go higher. It always does historically. We don't know how far. It could be 2 weeks, could be 2 months, but we'll ride that trend higher when we do, and it'll make up for all these paper cuts. And then eventually another bull market will turn, and we'll be compounding from a much higher asset base. I went through last week how we handled coming off the COVID low with the first 12 or so stocks that we bought. It'll be the same. It's the same playbook for when we bought them. We get on the indexes first, we let the leaders sort themselves out, then we take positions in the leaders and ride them as long as they'll go higher. We don't know. All you do is jump on the wave. You don't know how long or how strong the wave is going to get, but we ride the wave. We get out of the way when the wave's headed lower. When the wave wants to turn back higher, we'll be riding it. And if you are interested in this approach, we would love to talk to you. Email me, don@revereasset.com. You can also email my partner, Dan Stewart. He's a CFA and is the chief of all things financial here at Revere. That's dan@revereasset.com, or you can call 855-REAL-WEALTH. That's 855-732-5932. So let's take a look at this S&P 500 bar today. We'll go to the 5-minute chart, and you can see. So first of all, we were all the way up here on Netflix earnings, put some big enthusiasm in the market after hours yesterday. We made higher highs relative to the 18th, to Tuesday. But then by the open, as I mentioned, we gave it all back. We opened down, went a little bit lower, bounced at this 36.90 area, tried to make a run up to 37.28, then trended lower for a few hours, and then just reversed off this 36.67. You can see over here, over the last couple of days, yesterday the low 36.86, so we undercut that. If you undercut and reclaim a level, that's good. So we undercut 36.86, got back above it, closed at 36.95, and there's a bunch of congestion in here from 2 days ago, which was the first gap up around this 36.70, 36.86 level. So we held that, and as long as this level holds, really you can draw the line here, this 36.57, you can go to the gap up. As long as this holds, we're sticking with the few longs that we have and seeing where it takes us. We also took a short today. That's been something that we've been looking at for a while. We'll explain that when we get into the charts. But the bears tried to take us down today. The bulls tried to take us higher overnight. They failed. The bears tried to take us down. They failed. Kind of back to neutral now, right around this 36.70-ish to 36.20 area. 37.20. Let's see what tomorrow brings. We don't ever predict. Let's go to the NASDAQ 100. Weakest of the indexes. Right here, tried to get into the 21-day exponential moving average. Same thing, trend lower, stopped, minor uptrend into the close. Tesla after hours was down 6%, now down about 4%. that's having a decent size impact. Although after hours, the NASDAQ 100 is just down a fraction and the SPY is actually positive. So um, we'll see what tomorrow brings. Lately, the strongest of the indexes, which is very typical when you're in a correction, is the Dow Jones Industrial Average. You can see we've got 4 of the last 5 days we've closed above the 21-day exponential moving average, and it's hooked up. So the Dow certainly leading the way here. They've had some IBM reported after hours and was up too, so that's going to help the Dow. They had some bank earnings that helped the Dow. So some of these big blue chips having the effect on the Dow that it's holding it up better than the other indexes. Arguably, we had an undercut of 30,000 here. We held 30,000 here. We undercut 30,000 here, got back above it and are making higher highs. So this 30,000 is a key level for the Dow. I didn't do a daily chart on the NASDAQ 100. Let's do that quickly. I just showed the intraday chart. You can see here making a shot at the 21-day exponential moving average, but couldn't get over it. So did we undercut low 268.74, 268.08? So yes, we did undercut today, so it wasn't an inside day, but the bulls very much want to see us get above the 21-day exponential moving average in the NASDAQ 100. Now, mid caps have been strong lately, had a rough day today, closed just below the 21. This was the strongest, so this is looking like kind of like a shooting star. I'm not sure if there was enough power to technically call it an evening star, but we're sitting right on the 21. Not a good day in mid caps today. Let's go to small caps. Also not a good day here. One close above the 21, back below the 21. So all we've got firmly is the Dow above the 21. We've got the mid caps close. We've got S&P challenging. We've got small caps and the Qs below, but trying to get above, and the Qs haven't gotten above during this most recent leg, so they continue to lag. Lots of big, just one intraday move above yesterday, but couldn't hold it. Haven't had 3 up days in the market since going back to the beginning of September, so maybe it's just saying the market's just too weak. We really don't have a lot of good news from a macro standpoint, but remember, the market looks ahead 6 months. So if this is the lowest we're going to go, if inflation has peaked, if housing is at the worst that it's going to get, if the couple of interest rates that are scheduled to happen put a damper on things, and we go sideways instead of down, even though Bloomberg said there's virtually assured of a 100% recession next year. You don't know how bad that recession is going to be, but remember, the markets will bottom when the news is still bad because they are forward-looking. So those are the 5 major indexes. Let's go through the ancillary asset classes. Here's gold, continues to be garbage, down another 1.3% today. Let's go to bonds, TLT. The long-term treasury continues to make lower lows. Look how it's just riding this 8 EMA lower, can't get above it, no strength whatsoever. Let's look at the yield on the 10-year. Conversely, it made a higher high, and look how that's riding. The 8, one touch of the 21, just continues to ride the 8 EMA relentlessly higher. This is not good for stocks. One of our areas of focus is always on the dollar lately because of the big impact that it's having. Pulled back to the 21, bounced at the 21. Unfortunately for bulls, for stock bulls anyway, dollar bulls are happy. Bounced, got back above the 8 EMA. We need to see what's going to happen with this because bonds and the dollar are having a big impact on what's going on with the markets. No news on Bitcoin. We'll check in on the Bitcoin futures anyway, just for the hell of it. Continue to be flat. Look how bad ETHE is. This is a closed-end fund, or is it a closed-end fund? It doesn't trade at NAV, and it's bulletin board traded. So this has gone from 45 down to 8. Now Ethereum itself has not been this bad, so this is at a massive discount to its net asset value. I think there are some arbitrage plays on this that are just continuing to deflect the price. TBC used to be the other way. GBTC was the other backdoor way to play Bitcoin through this grayscale trust, but you can see this continues to trend lower while the futures are going sideways. So I haven't calculated the discount to NAV. It's got to be massive because Bitcoin is just really not down this much. Okay, so those are the other asset classes. We showed bonds, we showed gold, we showed Bitcoin, we showed the dollar. Let's get to the tail of the tape and see what's new here. Continued headwinds. Technical is a mixed picture, trying to get the stochastics to hook up. They're cooperating in some cases, not in other cases. Put call at 1.02, VIX at 31, still above these key moving averages. Let's look at the VIX. We need this to break below the 21-day exponential moving average and below 30. And I think this will give stocks a shot in the arm. I said I think. I hate saying I think. But the way that these are correlated, this will give stocks a shot in the arm if it breaks below the 21-day exponential moving average and this 30 level that it's been trending above for the last couple of weeks. Fear and greed unchanged at 8. Bull case had some more green lettering yesterday, back to neutral lettering today. Only one of the 5 indexes actually now, just the Dow, is above the 21-day exponential moving average. But let's see what tomorrow brings. So operating under the bear case right now, there's the overnight negative reversal on rising rates and the strong dollar. 2 up days, down to up to 1 down day now. Neutral coming into today because of the volatile undercut and recover and chop. Pullback S&P losing the 21-day as far as the support and resistance levels here that we're watching. We broke below this SR level, which is a pretty key one, this 3700 to 3715 to 3730. We're in the support resistance range here for the NASDAQ 100. Big fib below at this 258 that we undercut and recovered last week. Oil's about the only very positive sign for the market today. Dollar strong stocks finished positive. Marijuana stocks, a little bit of a comeback. They've been okay the last couple of days. Bonds negative, that means yields up. ITB, some really negative housing data came out. ITB down 5%. That's just brutal. Biotechs also took a big hit today. Down 4.9% on the XBI, 3.4% on IBB. That's awful. XLRE also continues to be weak, down 2.5%. The banks, my favorite bank stock got massacred today. Let's take a look at MTB. This is on the 21/21 list until today. When you're down 14%, they missed revenues, they missed sales. So say goodbye to the best looking bank chart that was out there. Banks were weak today, retail weak, and gold, silver, and gold and silver stocks have given up basically all of those gains from that brief strength that they showed a couple of weeks ago. So in focus today, after Netflix earnings yesterday, we wanted to see how this was going to hold up, and for the most part, pretty good. Into the 200-day moving average, and it failed right there. Need this to get above the 200-day. Let's look at an intraday chart here. Not bad. A lot of strength in the morning that coincided with index strength, ran into the 200-day, and then just kind of faded to the rest of the day, but not a harsh reversal. I think people got way too negative on it after their last 2 earnings reports. But see if we can get Netflix above the 200-day moving average. And then Tesla reported after hours. It was down more than it's currently down. It's trading after hours right now around 214, so just down $8. It was down in the 200s. Here you see it's down 3.7% now. It was down 6% at one time. So let's see how that reacts tomorrow. There is a story out there that Elon Musk has a lot of stock that he needs to sell now that the lockup is over. This 200 area is a key area on Tesla if that starts to sell off tomorrow, because he needs to raise some billions of dollars for the Twitter acquisition. That money's going to come from Tesla. I'm not predicting, I'm passing along what I've read. and a lot of people are a lot smarter about things like that than I am. So we'll be focusing on Tesla tomorrow as well as Netflix. The other thing we were looking at today was what about the follow-up strength on the days on the stocks that some of the tickers that I showed yesterday, and I'm highlighting these four. Um, Actually really five because I'm including the whole aerospace sector. How did they act today on the day after a day that was close to a follow-through day but faded? We were looking for some stocks with strength and volume. Let's go through these four real quick. You know we own HLIT. This got a price target raised today. It was very strong out of the gate. These volume patterns continue to be very positive. There aren't a lot of stocks still as strong as this. Again, because it's thin, all we have is a 2% position in it, but we don't want to add on strength. We want to add on a pullback to the moving average. You can see how it's been riding the ADMA on any pullback. BAH, Booz Allen Hamilton, a consulting stock. This was the big breakout yesterday. This gap down immediately at the open today. Note the nice breakout on volume from this nice flat base, amazing relative strength. Pulled back in an inside day today. All things considered, really not a loss. Didn't give up the low of the gap up day. It's right below the pivot. Hasn't triggered the 7% loss rule. So let's call this like kissing your sister, I guess we'll say, is what that is. We'll call it a tie for Booz Allen. AEHR, another strong stock, albeit thin and volatile, but one of the few that did show follow-up strength today off of its gap up on strength yesterday. Again, this is the silicon carbide test systems for semiconductors, very hot, very popular area. Look at the blue bars compared to the red bars for buying volume. It's very clearly under accumulation. Now it's at the top of this range of a flat base. I could argue that it's a big handle in this cup and handle. Pattern recognition is just showing this flat base, but definitely one to keep an eye on. AEHR and Deckers. I got some new running shoes, and I hadn't heard of the brand before. My son recommended them, and it ends up that Deckers makes them. They're called Hoka's, Hoka. Very happy with them. And Deckers attempted the breakout pullback on lower volume today. So two big volume up days, one lower volume pullback day. Relative strength very much showing there. Earnings in 8 days though. Let's see what happens to Deckers over the next week going into earnings. And then ITA, do we have follow-up strength on? Let's take a look at these three. We'll look at four aerospace stocks. So LMT was the one that reporting earnings yesterday. More follow through to the upsides. Good stuff there. Northrop Grumman was the leader before LMT reasserted itself. Another higher high here. Maybe there's some more coming that we don't know about. This really took off after the conference call today, which I haven't read the details on. L3 Harris, day a higher high for the second day. And General Dynamics, GD, higher high for the second day. So you've got four aerospace and defense stocks making a second day higher high after they were sparked higher by LMT's earnings. Certainly something to keep an eye on. And then oils were just a juggernaut today. We don't own any. We're looking at a couple of ETFs to possibly get into. Indexes in the dollar versus the 21. We already went over that. So now the Dan Stewart short that everybody's been waiting on. Here's XLRE. Dan started talking about shorting real estate a couple of weeks ago. He doesn't make many recommendations as far as, hey, Don, look at getting into this, but he's pretty adamant about this because he's seeing a lot of real estate collapsing around his area. So the Dow Jones Real Estate Index is RWR. Most of these indexes look the same. You can see this harsh move down, couple-day counter trend rally, another lower low, and then a move up into the 21-day exponential moving average that failed. With the lower low today, perfect opportunity for a low-risk entry into a short. It's a 3 times short DRV. Because it's 3 times, we only took a 1% position. But you can see it undercut and reclaim the 21, just very similar to the way that RWR got above and then failed at the 21. So our stop on this, we've got about a 10% stop on this as of right now. We're profitable on it. and we'll just move the stop up as the 21-day exponential moving average continues to move on RWR. Don't trust the technicals on the derivative. Always use the technicals on the underlying. In this case, it's RWR. So as this continues to go lower, we'll keep a little bit of a buffer above the 21-day exponential moving average, see if we can get a trend going on this. We'll add to it if we get a little bit of gains on it that would justify putting more money into it. But for now, 1% long on DRV, which is the inverse 3 times real estate, basically a way to play the real estate market short. So bottom line, overnight negative reversal, early strength fades, S&P loses the 21-day exponential moving average. We want to get back above this 37, call it 3,700 to 3,730 level, which has been support back in June and July. We've battled back and forth along this several times over the last month. 3712, the 21-day exponential moving average is in there. We need to break above this. 3720 was the prior high close, and then we'll set our sights on this 3800 area, which is a key fib on the S&P 500 to see if we can get up to it. So that's the way we see things here at Revere, and that's going to wrap it for the day. So as always, love to hear from you. The email is don@revereasset.com. Phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's never too late to sell if you have a plan to re-enter. We highlight our plans in our videos every night here as far as what our read on the market is, the things that we're looking at to get into if the market strengthens, and in the case of real estate, things that we'll get into if the market continues to trend lower. Usually we just do it with broad index ETFs on the fail of a moving average. In this case, we did it with the real estate sector. We're also keeping an eye on VGK, which is Europe. We all know that Europe's having some serious economic issues over there, all caused by their serious political mistake to rely on green energy. You can see Europe had 2 closes below the 21, back below it today. If we decide to short Europe, EPV is the one-time inverse Europe. That's how we will be playing it. EPV, and that's a 2-time short. But again, we're using the underlying VGK, which is the Europe Vandenbord FTSE Europe ETF as the benchmark. So that's going to wrap it. As always, as I said, like to hear from you. Remember, folks, it's not how much you make in the market, it's how much of that you can keep. I love to argue this fact on Twitter. Some people think that just because the market trends up and down that you can handle a 50% loss of your money during your career. That's just not realistic if you're approaching retirement. Give us a shout if you want to discuss it. So wrapping up Wednesday, October 19th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.